Hey, welcome back. We got another great webinar here for you this week. I know this is a topic we've always gotten a lot of questions about, and we're really happy to answer them. I'm Tom,
I'm Evan, as always.
and we're going to have a great discussion today on tax advantaged investment accounts. Kind of some different methods for saving you a bit of money on taxes while putting some money away for investing. Kind of the right way to set that up to make sure you're not messing things up for yourself.
Yes, absolutely. It can be complicated putting all this in systems and making sure it's working out the right way.
Mhm. So the big question is, why should you care? Why do you need a tax advantaged account? What's really the benefit of it? And the biggest thing is it's either going to be a pre-tax or post-tax account, which is directly going to save you on income taxes. So with a pre-tax account, that is a deduction you get to take when you contribute to that account. It comes right off of your ordinary income. It's saving you money immediately. Uh, but what's going to happen then is eventually when you take the funds out of that account, then you would pay tax on it. So it's really tax deferred is the better way to think about it rather than it overall saving you funds. It could save you if you have maybe a large income now that you want to try to reduce that now, and maybe a lower income in the future that you'll have a lower tax rate for, and you can realize that income then, save a bit of money. There's also that time value of money element. So being able to defer the tax now means you pay less now, and what you would have paid in taxes, you can invest that in something else. So that's a nice thing as well. But then you also have post-tax accounts, which allow you to have funds grow tax-free. So you don't get an immediate benefit from investing in the account, but all of that growth that it's experiencing, you don't have to pay any taxes on that, so long as you use it for whatever purpose that account is designated for. We do have the long-term capital gains rates on here, kind of what it looks like for at different income levels, what your income tax you'd be paying on maybe those gains that you're being able to not get taxed on in the post-tax accounts. Most folks are probably going to be over the limit for 0%. I want to say everybody, that is still a good chunk of change you got to make. But if you're over those, that's 15% capital gains tax that you just don't have to pay as long as you use the post-tax tax advantaged account. And that's really great. The other benefits, if it's through an employer, a lot of times there might be a company match. So that's free money. You don't want to pass that up. There's also that element of forced savings. Not everyone is great about, putting money, into the bank, investing it, and just not touching it. And so by having it in an account where there's a penalty for touching it, that can be beneficial. There's certainly a psychological element to that that really helps. And there is some limited protection from creditors. I would recommend investing into a tax advantage account just for the protection from creditors. But that is something you can at least consider that, it's at least a little more protected than if it's just sitting in the bank. So let's look at the different types of tax advantage accounts that you have to choose from. The biggest one that's going to apply to almost everybody is an IRA, an individual retirement account. And you got two different flavors of IRAs. You got the traditional IRA and you got the Roth IRA. The traditional, it's pre-tax, you get to deduct it right now. The Roth is that post-tax and it's going to grow tax-free. For both of these, you're really not going to start drawing anything until you're at least 59 and a half. There are penalties if you do so. There's a few exceptions that can apply to those penalties, basically financial emergencies, that sort of thing. They're quite limited. I wouldn't bank on being able to use any of those, except maybe there is an exception for being able to use some of those funds as a down payment on your first house. That is something nice you can do. Now, the bigger exception to that is when you do have a Roth account, you can draw your basis out at any time. So if you invested $5,000 into the account, maybe it grew to 5,500, you got to leave that 500 in gains in the account until retirement. But you can draw that 5,000 whenever you want. The only downside is, once you've taken it out, can't put it back in without hitting against your limit again. Um, There are income limits for a traditional IRA if you have a plan through your employer. You don't have a plan, there are no limits. So as long as you have ordinary income, you can contribute up to the limit. For Roth accounts, there is a limit. You got to have a lot of income before you actually hit that limit. I think it's around 220-ish. I think we actually might have it on the next slide of where that kicks in for those limits. So the other great thing about IRAs is you do not have to contribute in the same tax year calendar-wise as you're designated that contribution for. So right now, at time of recording, not very few people have already filed their 2025 1040s. You can still contribute to these accounts up until the deadline of 4/15. You get $7,000 for 25. You get 7,500 for 26. You get an extra 1,000 if you're over 50. They want you to try to put away a little bit of money before retirement with that. And that is the same limit for both accounts. So if you do 7,000 to your traditional IRA, you can't do anything to the Roth. Next, you got your 401ks. This is the most popular employer-sponsored plan. So that means there are usually employer contributions to these plans. Maybe they're matching, maybe they're profit sharing. There's usually some sort of vesting involved with those contributions. You got to be with the company long enough to take advantage of that. Any contributions to the account have to come from normal payroll. You can't just write a check. So that is a bit more limiting than the IRAs because you can't wait until the next calendar year before you file your tax return. You got to do it in real time with your regular pay. Most folks would do a pre-tax 401k. There are options for a Roth, which might make more sense at certain income levels. The nice thing is there are no income limits for a 401k. If you got a job and the employer sponsors the plan, you can make $1 million and you'd still be able to contribute to that 401k. With certain limitations on highly compensated employees, and that would depend on the nature of your plan. There are options for self-employed folks if you want to do a solo 401k. Very similar limits, but I think they're even a little bit better than what you would normally get. So that is something you can consider, but we do have a few other maybe better options for self-employed folks coming up. You may hear of 403Bs or 457 plans. Those are basically the same thing. It's just that those are for nonprofit and government entities. 401Ks are for for-profit entities. For 2026, you can put away 24,500, and you get a little bit of a bonus there if you are getting close to retirement age. Like I said, they want to make sure people are putting funds away for retirement, give you all the benefit they can. And there is that total limit up to 72,000 for the employee and employer together. A simple IRA, quite similar to a 401k, only it is simpler. There's a lot less flexibility with how the employer can set it up. But the upside to that is it's usually much cheaper for the employer to set up. You got to have 100 employees or less, so it is only really for small businesses. For the employer portion, you only get two options. Either you match dollar for dollar up to 3% of the employee's W-2 wages, or you can do 2% of their W-2 wages, regardless of how much the employee contributes to the plan. And just like the 401k, any employee contributions have to be through normal payroll. Again, it's usually pre-tax. Under the new laws with Secure 2.0, you can do a Roth. I've never seen someone do that. It seems a little silly to do that with a simple IRA, but know that that is an option. Again, there's no income limits for this. If you have a job and your employer has this plan, you can contribute. Contribution limits a little bit lower than they are with a 401k. You only get 17 grand as an employee, plus those bonuses if you're getting closer to retirement age. It's a little bit higher if there's under 25 employees, but not really much more. There's effectively no limit for the employer portion. I think it's something like 70 combined, but you'd have to have a really, really high W-2 salary for that to come anywhere close into play. A SEP IRA, those are pretty much only for self-employed folks. In theory, you can do one if you have employees, but it's really not a good idea because you're going to be giving away quite a bit more in employer contributions than I would say most people are comfortable with doing for their employees if you're using it to its full advantage, which is usually 25% of your self-employed earnings or the earnings from the business, um, or 25% of your W-2 compensation if you're an S corp. So that's quite a bit that you'd have to put away for your employees as well if you were going to do that. Similar to the IRAs, you can actually contribute after the calendar year. But for these, you even get until the extended deadline. Since you aren't really going to know how much the business has made until you're ready to file that tax return, they cut you a little bit of slack and they wait until you file that extended return before you have to make that contribution. Again, almost always pre-tax. Legally, you can do a Roth now. Not sure why anyone would want to in this instance. Next, you got health savings accounts. This is not for retirement necessarily, but these are funds you can use for your healthcare costs. You can pretty much use them on anything except your health insurance premiums. So they're quite flexible with what you can use them on, even if it's stuff insurance wouldn't normally cover, like maybe glasses, over-the-counter prescription or over-the-counter drugs and prescriptions, uh, orthotics, so something that is definitively for healthcare, but maybe not necessarily something insurance would be paying for. Big caveat to this, you need to have a high deductible health insurance plan. The IRS is pretty generous with what actually counts as a high deductible. It's only $1,700 for an individual or $3,400 for a family. I feel like a lot of people have deductibles well over that. So that part of it isn't too challenging to meet. The more challenging part can be this maximum out of pocket bit, because there are some plans that do have really high deductibles, and they also have very high max out of pocket. So there might be some that would not be eligible for these HSA accounts. As far as ACA plans, and this is a rather new development, if you have a bronze or even a catastrophic ACA plan, so very high deductible plans, those actually do still qualify for HSAs. So that is something nice that even if you don't have a very good health insurance plan, you can at least do the HSA, get some tax benefit out of it. And another difference between this and a lot of the retirement accounts is you can be set up by either individuals, regardless of their employer status, or by employers, allowing employees to contribute through payroll and even have employer contributions. If you do have that employer-sponsored plan, anything that the employee contributes is pre-tax, not just for income tax, but also for FICA, which is a big difference because for maybe 401k or simple IRA contributions by the employee, those are still subject to Social Security and Medicare. So that is a nice little benefit you can get there, a little extra tax savings. If you don't use it for healthcare costs, you don't lose it. So it does effectively work the same as a traditional IRA if you still have funds left over for retirement. Most folks don't end up in that situation. They prefer to use it on their healthcare costs over the years and even their healthcare costs in retirement, just because then you're not paying any tax on it. It goes in pre-tax and it comes out without paying any tax if you use it on those healthcare costs. Similar to the IRAs, you have until 4/15 to contribute for the prior year. If you are only covered by yourself in your health insurance, you can contribute up to $4,400 for 2025. If you have a family and your family is covered under that health insurance plan, you can contribute up to $8,750. That is quite a bit of money you could put away and use for your healthcare costs. Similar to that, there's also flexible savings accounts. These are only to be established by an employer, so you can't set one up unless you have it through your employer. There's two flavors of them. You have the one for healthcare costs, which work very similar to an HSA. You also have one for dependent care costs. You can pay for daycare out of that for your kids. So that can be a really nice benefit as well. Again, since it's through your employer might have contributions, they might not, really just depends. And it's also being made, the employee contributions through that normal W-2 pay. If it's a healthcare plan, you get up to $3,400 in contributions. If it's a dependent care plan, you get up to $7,500. Similar to the HSA, any employee contributions are not subject to FICA. So that is a quite a nice benefit. But the big difference is it is use it or lose it. So the HSA rolls over every year if you don't use it. With the FSA, if you have any money left in the account at the end of the year, you lose the tax benefit. It just comes back to you as normal pay. You pay income tax on it, and you don't really get any benefit out of it. So if you have a flex spend account, flex savings account, try to use that before the end of the year. You've also got 529 accounts. These are mostly for saving for college, usually for your kids. It could be for your grandkids. It could be for yourself. Really doesn't matter. You can kind of set it up for whoever you want. Um, so it's normally for college. It can also be for trade school. But you also don't even have to wait that long. You can use it for K through 12 tuition up to 10 grand a year. So that's a nice benefit if your kids are in private school. If you have a kid with special needs, you can also use the 529 account to pay for any education related costs for those kids. Um, and if you're already gone to school, you can actually use the 529 account to pay off some of your student debt, up to $10,000 your whole lifetime. So not nearly as much as you might have already accrued, but it's at least a little something that you can use. There is new parts of Secure 2.0 where you're actually allowed to roll this over into the beneficiary's Roth IRA if they don't end up going to college. So that, it's a nice benefit if maybe, they don't end up going to college, even though you save for it. That money isn't just lost or, there's no penalties on it for taking it out. You can at least do something with it. You can roll it over to that Roth IRA. It is not deductible at the federal level. That's a common misconception. It's only deductible at the state level. But at both the federal and state level, it enjoys that tax-free growth. So there is still a pretty nice benefit to using the account. Um, Unlike maybe just giving the money to your kids or whatnot, the account owner is going to control those assets, even if your kids are grown, they're adults now. So that is a nice benefit to it. It's not up to the beneficiary to decide when those funds are distributed. It is up to the account owner. The other nice thing is you can actually change the beneficiary. So maybe you have two kids who saved up for one kid's college and they didn't end up going, but maybe the other kid went. So you can just change the beneficiary and use those funds just as easily for the other kid. There's also no limits to the account, at least for income tax purposes. There's only gift tax limits. So for most folks, gift tax is never going to matter. You got to have tens of millions of dollars in the bank before that even comes into play. So, but if you stay below $19,000 if you're single, or $38,000 if you're married per year, you won't even hit the gift tax threshold for filing a gift tax return. So there won't be any issues whatsoever. You may have heard of a Coverdell account. Those are no longer relevant, given the fact that you can now use a 529 account for K through 12 tuition. So if anyone tries to sell you on one of those, just tell them, nope, I want a 529 account, because that's what makes sense nowadays. And lastly here, we have the brand new 930A accounts. These are part of the big tax bill that was passed last year. The accounts are not live yet. You're going to be able to open those accounts starting in July. I believe with your 2025 1040, you can include a form where you request to open that account when the time happens. Our current guidance is maybe don't go ahead and file that form just yet, because it's going to be very easy and straightforward to open the account come May or June without having to include that with your 1040. And there is still a lot of unknown about how these accounts are going to work. What we do know right now is that for any kids born between January 1st of 25 and December 31st of 28, the federal government is going to deposit $1,000 into that account that's going to be invested. Additionally, as of right now, any children that are under the age of 10, but I believe born before January 1st and 25, not 100% sure on that, they are still going to receive $250 from corporate donors to those accounts. That could increase in the future if there's more corporate donors, but as of right now, that's where we're at. Parents and families can contribute up to $5,000 to these accounts per child, but that is not deductible. So it's not going to be an immediate tax benefit to it. Employers can also contribute, and that at least has the FICA benefit of it. But again, not a huge benefit from those contributions. Um, Kids will be able to draw those funds the year they turn 18. They don't have to use it for education. They can use it for whatever they want. But it is also their funds. So unlike the 529 accounts where it is in the control of the account owner, this is the kids' funds. So when they turn 18, it's their money. They can do with it what they would like. They can buy a car, they can go to college, whatever suits them best. What is interesting about these accounts is unlike Roth accounts where there's no deduction up front, but it grows tax free, these funds do not grow tax free. They grow tax deferred. So the only real benefit you're getting from the account is the fact that you're not paying any tax on it if it's reinvested. Because keep in mind, if you don't sell any securities, they're still just growing. Those are unrealized gains. You don't pay tax on those anyway. So this isn't necessarily as advantageous of an account as some of the other ones we talked about. The other biggest thing is, unlike all these other retirement accounts and healthcare accounts, where you more or less have control over how those funds are invested, maybe it's little bit limited. You know, I might only have certain options. There is not going to be control over how these funds are invested. It's basically going to be one big fund that the federal government manages, with whatever investments they decide are appropriate.
All right, and that is my segue into talking about the fun part, which is coding all of this in your payroll system, getting all this set up properly. If you do have errors, what you should do, how you can fix them, and all that good stuff. I do want to just give a small disclaimer. When I'm talking, I'm generally thinking payroll relief because that's the system we use. There are going to be some light discrepancies. So if you're using a different system and you hear something I say and you're like, that is not correct, keep in mind I'm operating off payroll relief, which is what most of our clients are using because they're coming to us for payroll. So just a thought. I'm going to show some screenshots as well that might not be, if you're using QuickBooks or something like that for payroll, might not be exact, but the concepts will be the same. So generally, we try to split two things between deduction and retirement. The reason we do that is because when you have a retirement set up, there's typically a retirement plan that has to be set up in the system. So when it comes to a deduction, like an HSA account, I can typically just throw that deduction in, make sure the account is hooked up, and then we are good to go. That money is going to go to the employee. When it comes to these retirement accounts, though, there's all kinds of different fiddly bits that can go into them. You got the employer matches. You've got, some folks have unions and they've got opinions on what's going on in the 401k there. So, there could be some extra bits besides just putting a set amount into your bank account. And so we have to set that up on the back end. And that's why I try to defer those two. They folks sometimes will go in, they'll see the deduction tab, they'll say, hey, 401k is under those deductions, throw everything in, and then, we don't get that money to where it's supposed to go. So this is just something I want everyone to be aware of. That said, when you come over to the deductions tab in payroll relief, everything will be there. Ideally, you're going to be just looking for what exactly you're looking for. So if it's 401k, you're looking for the 401k. But there are some things that are extremely similar. And this was a list I kind of curated and added some things that were extremely similar so you guys could kind of see what I'm talking about. There's an FSA dependent care. There's an FSA dependent care joint or single. So, there's some tiny minutia in the systems about, the differences between these. This one is for an employee who's over 50 as opposed to someone who's just on a 401k. So these are just things you need to be keeping in mind so you don't accidentally code something wrong. You don't set it up incorrectly. These funds will get deducted from the employee check. So some folks have come to me and they have said, hey, I have an HSA account. It is $200. Where is the $200? It got deducted from your account and it's going directly into that HSA account. We are, some folks are thinking that they're going to get that money on their gross and then they're going to be able to distribute it to where they need to. If it's set up in the system properly, should automatically deduct it. Employee doesn't have to worry. Their HSA account goes up. Everything's good. If you don't have a deduction on here, so say I'm looking through and I cannot for the life of me find, 401ks. You can set up a miscellaneous deduction. The one thing I will say is you have to make sure that all the taxes are set up correctly on that miscellaneous deduction. So if you do not know what's going on, if you're like, I really couldn't tell you if I'm exempt from FICA on this or not, I highly, highly recommend reaching out to your payroll provider. We are going to be able to help you. We're going to be able to say, hey, yeah, that's exempt. Hey, no, that's not exempt. And you don't want to just put something out there and hope it sticks because as I will get to here, there are some issues if you don't do these things correctly. Um, like I mentioned, there will be a banking setup for things like HSA accounts. You want to make sure that the funds are getting to where they need to go. So once you set these contributions up in the system, typically somewhere will pop up that says, hey, this is for retirement. This is for your HSA account. You need to put the bank account that this money is going into there. I've seen folks before, they set all the deductions up. It deducts the money from the account, but then it doesn't take the money from, the employer. It just sits in the business account and that deduction doesn't actually get to where it needs to go. So make sure when you're setting those deductions up that you are making sure that the bank account is also hooked up as well. You can typically do this in your payroll software, but again, if you're one of our clients, you could reach out to us on this and say, hey, I'm not sure how to do this setup portion. Can you give me some help? We try to do the back end kind of stuff for you, so you're not, trying to distinguish if you're setting taxes up correctly or anything like that. That's our expertise, so we'll be happy to take a look at that kind of stuff for you. But I know some folks do set some of this stuff up on their own or use a different payroll system, so I just want to be clear. And once things are set up properly, you should be able to pull them on reports. So if you go through and you start pulling reports of your deductions and you're seeing no deductions, that's a big red flag. Make sure that things are showing up. There might be, a different report set somewhere. Again, we can help you find this if there were anything like, yeah, for example, certain things only show up on retirement contributions and payroll relief, not necessarily on like the overall deductions tab. So if you're having trouble finding anything, let us know. But if you do comb through all those reports and you're like, there is no evidence that this has happened, please let us know. That's something that can be a problem in your payroll system. Um, when it comes to employer contributions, certain systems, including payroll relief, unfortunately, have issues properly handling those. So if I go in and I type in an employer contribution, everything is set up in payroll relief. And if you ever get in there and try to set that up, it will look like you can set everything up to where it needs to go. It does not function. And the reason I clock that is like the prior slide, nothing comes up on reports. So that means somewhere in the system there's a disconnect, and we've got a confirmation from payroll relief even that there's a disconnect. So, when you're setting up these employer contributions, I urge you to be very careful. Once you verify that they are functioning in the system, we really just need to make sure that those funds are going to the employee account. So if you can't get it set up, make a note of it. You're going to probably have to delegate those funds yourself. But if you're not sure, again, reach out to us. I can confirm, especially on the payroll relief end, if something is working or not. Then why does accuracy matter? There are a whole slew of things that can happen if you just accidentally click the wrong code. So a lot of these are on the W-2. Most of them are in box 12. And it can be hard to distinguish like, oh, it looks like it's correct. All of my 401k stuff is showing up in box 12, even though I coded it as an HSA. But that code W versus the code D is going to be your distinction there. You really want to just make sure that everything is good because again, some of these are exempt from FICA, some of them aren't exempt from FICA. If you've got the wrong account selected and you're not paying a totally, correct slew of taxes, it can just cause a mess of compliance issues. We're going to have to amend that W-2. It can just cause you lots of problems. You don't want to be doing tax cleanup just because we clicked the wrong thing in a drop-down menu. The taxes might vary. I know I already said this. I really like to harp on this. They might vary. Make sure you're setting up that right account. When it comes to your common errors, I know things can seem catastrophic when something comes to you and you go, oh my God, for a whole year, this HSA account has been miscoded as an FSA account or something that seems just totally catastrophic. We clearly haven't been doing it right. But in most of these cases, there's a form with the IRS on how to get everything fixed up. So like I said, you can amend those W-2s. If you notice that any contributions on an employee account were missed, you can correct this upon discovery. So don't just, let it slide and go, well, I didn't notice. Just immediately correct that on discovery, get that fixed up for them immediately, and you won't have any problems with that. I believe the actual timeline on it is you have 90 days after discovery typically, but the government even says try to knock it out instantly once you discover those things. Those, like I mentioned, tax discrepancies, if you got the wrong code. If you have the wrong type of plan, like 401k Roth instead of a 401k or an HSA instead of an FSA, contact your payroll provider and the IRS. There are correction forms. We can make sure that those funds reach the right place. They're not gone, but we want to make sure that you're compliant and the government doesn't come down the road later and go, "Whoa, what's going on here? This is a mess." So just as long as you catch it, notify everyone, we can get it corrected. And if it's something as simple as like, I don't know, last week on payroll, we missed someone's contribution, you can double up the next week. We can make sure, hey, I'm gonna correct that. We're gonna get that deduction in on the next payroll. So there are ways to get this fixed. Never go into a panic. Just come to us and we can help you get that cleared up. And this is just our contact info. So if you want to give us a call, get to our website. This is where you'd go. We're taking new clients. So if you need anything and you're not with us currently, feel free to give us a ring or an email or check out the website, poke around what we got. We've got good resources on the website. So yeah, this is sort of just our plug to get you looking at our good stuff that we can offer you.
All right, sounds good. Well, if you have any questions, you can always reach out anytime. We'd be happy to help. You can always hop on to the next webinar. We're here
Absolutely.
every Friday, 2 p.m. Central Time. Happy to, help everybody out in any way we can.
Thanks, folks.